Hello, this is Leroy Meadows, and I want to welcome you today to our session on cost volume profit analysis. And in this session, we're going to examine the relationship between total revenues, total costs, and operating income as changes occur. This session is going to be predicated based on prior knowledge of cost behavior, identifying fixed and variable costs, and separating mixed costs into their fixed and variable components. So if you are not familiar with that, or you need to brush up on that, go back and see my video on cost behavior. So let's go ahead and move forward here and let's take a look. Cost volume profit analysis is a study of the behavior of total revenues, total costs, and total income when any of the following changes occur. When we have change in units sold, change in selling price, the variable cost per unit changes, or we have a change in total fixed cost. Now, again, recall the basic formula for measuring total cost is total costs equals total fixed costs plus total variable costs. And again, if you need to, go back and watch my video on cost behavior. That will help expand your understanding if you need to refresh as far with regards to fixed and variable costs and how they behave. Understanding that and understanding those behaviors will aid you greatly when we're doing cost volume profit analysis here. So CVP analysis, and that CVP is just abbreviation for cost volume profit analysis. So CVP analysis just focuses on the cost behavior when analyzing data and making decisions. Now, the first step is to separate our variable costs from our fixed costs. If we have any type of mixed costs, we need to go ahead and use either the high-low method or regression analysis we talked about in cost behavior to separate those costs. Once we've got those costs separated, then we can continue. Now, let's take a look at some important calculations in CVP analysis. The first one is measuring contribution margin. And contribution margin is going to be simply total revenues minus total variable costs. Now I can compute the contribution margin per unit, and there are going to be times where I need to compute that contribution margin per unit. So now I'm going to take that first formula and just tweak it just to get it on a per unit basis. So how am I going to do that? My contribution margin per unit is simply going to be my sales price per unit minus my variable cost per unit. So contribution margin per unit, let's say my sales price is $5 and my variable cost per unit are $3, then my contribution margin per unit is $2. I can also calculate total contribution margin by taking my contribution margin per unit times the number of units sold. So my total contribution margin, if my contribution margin per unit is, let's say, $5 and I sell 200 units, well, my total contribution margin is going to be $1,000. Again, $5 for contribution margin per unit times the number of units sold gives me $1,000. So then we have the contribution margin ratio percentage, which is simply my total contribution margin divided by total revenues. And I can actually calculate the contribution margin ratio percentage on a per unit basis. Unit contribution margin divided by unit sales price. Now my contribution margin percentage, because it's stated as a ratio, if I figure my contribution margin ratio on a total basis, total contribution margin divided by total revenues, and let's say that comes out to be 47%. My contribution margin ratio on the per unit level will be 47% also. Because now we're looking at ratios, we're comparing apples to apples. So that percentage or that ratio should be the same across the board, whether in total or on a per unit basis. Now let's look at the contribution margin format income statement. The contribution format income statement is going to be different than your gross margin format income statement. Your gross margin format income statement is simply taking your total revenues minus your cost of goods sold to get your gross profit. From your gross profit, you subtract out your operating expenses such as selling and administrative expenses to get your operating income. And we're focused on classifying those costs under the gross margin format income statement as either product costs or period costs. In the contribution margin format income statement, we're not focused on product and period or inventoriable versus period. We're focused on cost behavior, not cost classification. So my cost contribution margin format income statement is based on cost classification. Well, I'm going to take my total revenues, subtract out my variable costs to get my total contribution margin. From that, from my total contribution margin, I'm going to subtract out my fixed costs to get my operating income. So the focus of the contribution margin format income statement is to highlight operating income or loss at various levels of activity. Let's take a look at this illustration here on the screen. My sales price is $100 per unit that I sell to customers. The variable costs are $60 per unit. So my contribution margin on a per unit basis is $40. Now, if I sell just one unit here, I want to have my total sales of $100, subtract out my 60, leaves me a contribution margin of 40. And out of that 40, I have to cover my fixed costs. Obviously, if I'm only selling one unit and my contribution margin for that one unit is $40, am I going to cover my fixed costs of $1,500? No, I'm not. So I'm going to have an operating loss if this period I only sell one unit. But let's say instead of selling one, we sell 10 this period. So what are my total revenues? Well, if I sell 10 units at $100 per unit, my total revenues are going to be $1,000 here. Subtract out my variable cost of $60 per unit times 10 units is $600. And now I have contribution margin of $400 with which to cover my fixed costs. Now I only have $400. My fixed costs are $1,500, so I still have an operating loss of $1,100. Now let's take a look at whether I sell 25 or when I sell 25 units. Well, if I sell 25 units at $100 each, I'm going to have revenue of $2,500. Subtract out my variable costs of $1,500 in total. How did I get that? $60 per unit times 25 units sold, $1,500. That leaves me with a contribution margin of $100 with which to cover my fixed costs. Now my fixed costs are $1,500, but at this point I only have an operating loss of $500. So do you see the way that this is progressing? This contribution margin format income statement lets me see the impact on operating income as the different levels of revenue or different level of units sold has changed. And that's all because I'm focusing on cost behavior and not cost classification. Now let's say I sell 50 units. 50 units I sell. Wow, I'm really selling my widgets here. At $100 per widget, my revenue is going to be $2,500, or is going to be 50 units, or 50 units, $100 per unit, $5,000. Subtract out my variable cost is $60 per unit, and I have $3,000 with the variable cost. So now I have contribution margin of $2,000. Now I've got $2,000, and my fixed costs are only $1,500. So now I have operating income of $500. And you can see how that progressively, the more I sell, I can get to the point where I'm seeing that what happens here. Somewhere in between selling 25 units and 50 units, guess what? I'm going to break even. Why? Because I had an operating loss here when I sold 25 units. I have an operating profit or an operating income of $500 here. So I know that somewhere in between 25 and 50 units sold, I'm going to break even. So now there are 4 assumptions we're going to make when we're performing cost volume profit analysis. we're going to assume in this profit analysis here that change in cost and revenue right here, all these numbers here are going to change only because I'm selling more or less. So I'm only because there's a change in units sold. My per unit cost, in other words, my per unit costs are going to remain the same. The second assumption is that total cost can be separated into two components, fixed and variable. And I do have that here. Fixed here, variable here. When graphically illustrated, the behavior of total revenues, total variable costs, and total fixed costs are going to be linear in nature. Remember when we talked about cost behavior, we talked about linear costs versus nonlinear costs. Linear costs those costs are going to be expressed in one big fat straight line. And we're going to assume the selling price, variable cost per unit, and total fixed costs are all known and constant. So now let's express the CVP relationship. There are three ways we can express the CVP relationship, which is the equation method. The equation method is revenues, total revenues minus variable cost minus fixed cost gives us our operating income. This is just a basic formula. Then we have the contribution margin method, which simply takes our contribution margin per unit times the number of units sold, and from that amount we subtract fixed costs to get operating income. Then we have the graph method, and the graph method is just simply stating the CVP relationship on a graph, and I'm actually going to come back to that graph here in this page in just a little bit once we get a little bit further along here, and then I'm going to come back here, explain what the different points and the different areas mean. So let's get forward here. Let's get forward to the break-even point, and let's start understanding some of this so we can go backwards into that graph and make some sense of it. Now, the break-even point is simply the number of units that we need to sell in order for it to break even. And when we're breaking even, what are we saying? Well, we're saying that operating income is zero, or another way that we can state that is total revenues equals total cost. Now, the break-even point is calculated as this: fixed costs divided by the contribution margin per unit. So to determine how many units we need to sell in order to achieve target operating income, because face it, do we want to just break even as a company? No. We want to earn operating income. We want to earn some money, earn some profit. So we can adjust this formula up here to determine how much we need to make in order to achieve a specific level of operating income when selling a particular product. How do we do that? Well, we're going to adjust that formula just a little bit, and instead of just fixed costs divided by contribution margin per unit, we're going to take the total of fixed costs, add in our target operating income, and when we get that to add those together, and then take that total and divide it by the contribution margin per unit. So let's do an example of both just a break-even point and how many units we need to sell in order to achieve target operating income. Acme Widget Company sells widgets. Its most popular widget sells for $8. Variable costs are $3 each, and total fixed costs are $3,000. How many units must Acme sell in order to break even? So let's take a look here. I'm going to take and use that break-even point, the first formula we did over there, fixed costs divided by my contribution margin per unit. So my fixed costs are $3,000. I'm going to divide that by $5 per unit of my contribution margin, and my break-even point is 600 units. Again, how do I get my contribution margin per unit of $5? I take my sales price per widget and subtract out my variable cost per widget. So $8 minus $3 gives me my contribution margin of $5 per unit. So when I take my $3,000 of fixed costs in total divided by my contribution margin of $5 per unit, my break-even point is 600 units. In other words, I have to sell 600 units of my most popular widget just to break even. That's not even to earn an operating income. That's just to have zero operating income, or where my total revenues equal my total cost. But hey, are we satisfied with just breaking even? No, of course not. What if the Acme Widget Company wants to make $2,000 of operating income? How many widgets must a company sell? So in order to earn target operating income of $2,000, I'm going to adjust that break-even formula, and I'm going to add together my total fixed cost plus my desired operating income. And remember, from up above, my fixed costs are $3,000. Add to that to my $2,000 of desired operating income, and that gives me $5,000. Take that total of $5,000, divide that by my $5 contribution margin per unit, and in order to earn $2,000 of operating income, I must sell 1,000 units. I must sell 1,000 widgets in order to make my target operating income of $2,000. Now, to determine how much revenue we need to generate just to break even, I could take my fixed costs divided by my contribution margin ratio. This is how we can calculate the break-even point target operating income in revenues, so in the total sales amount. And to determine how much revenue we must generate in order to achieve target operating income, take my fixed costs, add that to my desired operating income, and divide that by my contribution margin ratio. So just to break even, how much in sales do I have to have just to break even? My fixed cost divided by contribution margin ratio, and to determine how much revenue I must generate in order to achieve target operating income, my fixed cost plus target operating income, add that together, and divide that by my contribution margin ratio. So let's take a look at Acme Widget Company again. Acme Widget Company sells widgets. Its most popular widget sells for $8. Variable costs are $3 each, and total fixed costs are $3,000. How much revenue does Acme need to generate from selling widgets just to break even? So I'm going to take my break-even sales, or my fixed cost of $3,000, and divide that by my contribution margin ratio. How do I calculate my contribution margin ratio? Well, I'm going to take my contribution margin, and what is my contribution margin here? $8, my sales price, minus $3 of variable costs, give me $5 contribution margin. My contribution margin ratio is that $5 of contribution margin divided by my sales price per widget of $8. When I take my contribution margin and divide that by the sales price, I will get a 62.625 ratio. So that's my contribution margin ratio. So I'm going to take my break-even, or my fixed cost of $3,000, divide that by my contribution margin ratio of 0.625, and my break-even sales will have to total $4,800. So so I got to sell $4,800 worth of widgets just to break even. But what if Acme Widget wants to earn operating income of $2,000? How much revenue must be generated? Again, I'm going to take my fixed costs plus my desired operating income. When I add those together, it's going to be $5,000. And I'm going to divide that by my contribution margin ratio, which we determined just a few seconds ago, of 0.625. In other words, 0.625 or 62.5% of that sales price represents contribution margin. So that's what contribution margin ratio represents. How much of the sales price represents contribution margin? So in order to figure out how much revenue I must generate in order to earn $2,000 operating profit, add my fixed cost of $3,000 plus my desired operating income of $2,000. Together, that gives me $5,000. Divide that by my contribution margin ratio, and in order to make $2,000 profits of operating income, I need to have revenues of $8,000. Now, what about the tax man? You know the tax man's coming, and he's going to come knocking at your door whenever you make money. Even when you don't make money, he still wants to know about your situation. But assuming we're going to make a profit, what about the tax man? Well, we got to take into account taxes when we're looking at the bottom line or net income. And if we want to go that far and take into account the tax man, Then we can take this, and let's remember net income first. Let's go back to net income. What is net income? In essence, net income is operating income plus non-operating income minus non-operating expenses minus taxes. And when we do all that together, that gives us net income. Now, for our purposes, we're not going to take into account non-operating income, non-operating expenses, but we are going to take into account taxes. So for non-operating income, non-operating expenses, we're just going to ignore those and pretend those don't even exist because we can't even control that anyway. So since that's out of our control, we're going to eliminate those. And we're just going to say operating income minus taxes equals net income. So how do we account for taxes in searching for target income? Well, we can slightly alter that break-even formula, though, that formula we just used, to account for taxes. Now, this formula on your screen is going to look a little wonky there, because you can see some brackets and a number of parentheses and everything. But that's just to help us follow the order of operations. So if you're doing this on a calculator or in Excel, you want to make sure that you have these brackets and parentheses in so that your order of operations will be correct, so that you'll get the correct number of units to sell. Now, the first thing I need to do is take my fixed costs, and I'm going to add to that my target operating income divided by 1 minus the tax rate. So how can I do this? I'm going to take my tax. What is the tax rate? Whatever my tax rate is, I'm going to subtract that from 1 to get my profit rate. Then I'm going to take my target income, divide that by my profit rate, add that to my fixed costs, and divide that by my contribution margin per unit. Wow, I just did a lot there, didn't I? I just talked myself probably into confusion, but let's take a look at that. Suppose the Acme Widget Company's most popular widget sells for $8. Variable costs are $3 each, and total fixed costs are $3,000. The company wants to have $3,000 of net income, and the company's tax rate is 40%. How many units must the company sell to achieve its objective? And now we're going to work on this formula here, and we're going to work, and I want you to ignore the bottom 3 computations there, because those just all bring it together here. Let's just look and break down that main formula and put it in its place. The first thing I want to do is figure out what my tax rate is. The problem tells me my tax rate is 40%. So I'm going to take my operating income and divide that by 1 minus 40%, or 1 minus 0.40. 1 minus 0.40 could also be stated as 0.6, because it's the same thing. 1 minus 0.4 equals 0.6. 0.4 plus 0.6 equals 1. So I'm going to take my $3,000, divide that by 1 minus the tax rate. And what does that get me? That gets me $5,000. Add to that my fixed income, or my fixed cost rather, of $3,000. And now I have a total of $8,000. Divide that by my contribution margin per unit of $5. And I need to sell 1,600 units. So again, let me go through this here. 3,000 divided by 1 minus 0.40, which would give me 0.6. 1 minus 0.40, 0.6. So 3,000 divided by 0.6 is going to give me 5,000 here. So that's what this is right here. So that 5,000 I got here, that's my desired operating income, because that's not taking into account taxes. We're backing the taxes out here so that we can get the amount of operating income, and then we're going to add that to our fixed costs of $3,000, which is 8,000 divided by $5 contribution margin per unit, and then I need to sell 1,600 units. So that when I sell 1,600 units, I am not only going to cover my fixed cost of $3,000, I'm going to have operating income of $5,000, and 40% of 40% taxes on that $5,000 will leave me $3,000 of operating income, or net income rather. $3,000 of net income. So there we go. We can take into account taxes and not have to worry about the tax man coming and giving us a surprise when he knocks on the door. We can be ready for him. So now let's take a look at the decision-making process. We can use CVP analysis when making certain decisions to view its impact on operating income. Advertising costs. We can add advertising costs to the numerator part of that formula to see how many additional units we must sell if we undertake an advertising campaign. Let's take a look at Acme Widget again. I love Acme Widget. I don't know why, but I just love Acme Widget Company. Acme Widget Company sells widgets. Its most popular widget sells for $8. Variable costs are $3 each, and total fixed costs are $3,000. Acme currently desires operating income of $2,000. To help the company achieve its goal, management has hired the marketing department to spend $500 in advertising costs. How many units must a company sell in order for the advertising campaign to be effective? In this case, we have to add in the advertising costs to our fixed costs and target operating income, because we got to account for that in order to see how many units we have to sell just to cover the additional costs of the campaign, of the advertising campaign, and then we can determine what we need to sell. So I'm going to take my fixed cost of $3,000, add to that my desired operating income of $2,000, add to that the advertising costs I need to cover now, add those together, and I get what, $5,500? Divide that $5,500 divided by my contribution margin per unit of $5. And in order for that advertising campaign to pay off, I need to sell 1,100 units. So in other words, with an advertising campaign, I have to sell 1,100 units just to cover my advertising costs. If I sell more than 1,100 units, then I've generated additional operating income I otherwise would not have had without that advertising campaign. But if I sell less than 1,100 units, then the advertising campaign was just a waste of money, because I'm actually losing more money than that $500 has not generated its return that I need. We can also use CVP analysis to determine the effect of a lower selling price on operating income. Now, it stands to reason that if all else stays the same and we lower a sales price, that we're going to have less operating income. So the reason we might want to lower the sales price is to see if we can sell more units and move more units through. That's why sometimes companies will lower the sales price to get more people to buy. So let's take a look at Acme Widget Company again. Acme Widget Company sells widgets, and its most popular widget sells for $8. Variable costs are $3 each, and total fixed costs are $3,000. The current break-even point is 600 units. Management believes that by lowering the selling price by $1, it can generate an additional 100 units of sales. Will the company break even with this new lower selling price combined with increased sales? Let's take a look here. So if we lower the sales price, we just have to adjust the break-even formula, which is the number of units to sell. I'll take my fixed costs of $3,000 and divide that by my new lower contribution margin. So now we're looking at, instead of selling it for that widget for $8, let's sell it for $7, and let's maybe sell more. Okay. So if I lower my costs or my sales price from $8 to $7, my contribution margin per unit is going to be lower. So if I take those $3,000 of fixed costs, divide that by my new lower contribution margin per unit of $4, the number of units I'm going to have to sell is 750. So in this case, you can see by lowering the sales price, I have to sell another 150 units just to break even. And since we saw in the problem, the company believes it can only generate an additional 100 units of sales, should we undertake the sales price reduction? Absolutely not, because now we won't even break even. So we were break even before, we are lower than break even now if we undertake that sales price. So no, under this case, because my units to sell increased from 600 to 750, there's a 150 unit increase I need to sell. If I'm only going to sell 100 units and not the full 150 I need to break even, I should not undertake this reduction of sales price. And I want to make a note here that not all products are price elastic. Some products will not see increased sales just because the selling price is lower. So this goes back to economics in dealing with price elasticity and inelasticity. So we want to make sure that we're aware and we know the market, the product, and our customers. Because not all products are price elastic. Not all products will generate additional sales just because we lower the sales price. If something is a piece of junk, it's going to be the same piece of junk at $8 a unit or $10 a unit or 50 cents a unit. You might find some poor soul that would buy it at 50 cents a unit, and instead of our normal sales price of 8 or 10. But that's because they were just wanting to pick up and get some good deals, maybe sell it on Amazon or eBay and try to flip it or whatever. Maybe take it to liquidations or whatever. But in generally, not all products are price elastic. So we're not going to see those sales increase just because the selling price is lower. So just keep that in mind whenever you're determining your sales price. And this is a good principle for any type of company, whether it's a merchandising company, a service company, or even a manufacturing company. Not all products are price elastic, so just because you lower the prices does not necessarily mean you're going to see the corresponding bump in sales to cover that reduction in sales price. Now, sensitivity analysis is a what-if technique that allows managers to see how an outcome will change if the company does not achieve its original predicted data, or if there's a change in one or more of the underlying assumptions. Remember from before that at the beginning there, we talked about, let me go back here, our underlying assumptions, and where are they on the screen? Okay, the assumptions we're going to make. Changes in costs and revenues rise solely because of change in units sold. So everything here in this table there is going to change only because of the number of units sold. But what if selling price changes, variable cost per unit change, and total fixed costs change? Then we have sensitivity analysis to look at how it's going to change the bottom line when we have a change in one or more of the underlying assumptions. Now, the margin of safety is another topic I want to introduce, and that's the amount of sales, and we can express this in units or dollars. So it can be expressed in dollar terms or in the number of units sold above the break-even point. Why does it have to be above the break-even point? Well, because that margin of safety, or the difference between the break-even point and our actual sales, if they're above the break-even point, that's the cushion. We have a cushion, and that margin of safety is that cushion in which a company has before sales drop to the point where it's just breaking even with no operating income or loss. So it's the amount of sales in units or dollars above the break-even point. So that difference between the break-even point and the amount of sales, it's that cushion the company has before it drops to the point where it is just breaking even. So Acme Widget sells this widget. Its most popular widget. It sells for $8. We just love Acme Widget, don't we? Variable costs are $3 each, and total fixed costs are $4,000. Management anticipates that 1,000 units will be sold this period, was the company's margin of safety. Well, we have to compute the break-even point. And in this case, I switched it up just a little bit. So it's not quite the same numbers before, but it's just as much. Just almost the same. Fixed costs are $4,000. So we need to figure out the break-even point first to determine if we even have a margin of safety. Because if I'm selling 1,000 units and my break-even point is 1,200 units, do I even have a margin of safety? No, I do not. I do not have that cushion because I'm not above the break-even point in the sales. So let's break-even point 800 units, taking my fixed cost divided by my contribution margin per unit, $800. So what is my margin of safety? It's my actual sales minus my break-even point in units, and that gives me 200 units. So my margin of safety expressed in units is 200 units. So I can express my margin of safety in dollars as 200 units times the sales price of $8 per unit. My margin of safety is $1,600 per unit. I can also express that margin of safety percentage as is simply the margin of safety in dollars, 1,600, divided by my total sales in units times the sales price per unit of 8,000. So if I sell 1,000 units, I'm going to have $8,000. Take my margin of safety, 1,600, divide that by my sales of 1,000 units, $8 a unit, and my margin of safety is 20%. So the margin of safety percentage, again, is that cushion that we want to use to where we have, if we want to know how much can sales go down before we break even. And sometimes we just need to figure that out because we may foresee something coming up on the horizon, maybe within the next month, 2 months, 3 months, and we might want to be able to make and see how much of a safety cushion we have before we have to make some adjustments. We can also use CVP analysis to look at alternative cost structures. And I got an example here to really illustrate the alternative cost structures here. Your wonderful instructor has just written a new cost accounting book. To promote the book, your instructor has chosen to go to a book fair in Cleveland, Ohio. The book sells for $100 and the variable cost to print the book is $50 with no fixed costs. So the fair has 3 options for renting a booth to promote the book. Which option should your instructor choose? Now the book has no fixed cost, but as we're looking at these different cost structures, we might see some fixed costs. I just want to clarify these no fixed costs statement is referring to the cost of the printing of the book, not to these other cost structures. So option number 1, $1,000 fixed booth fee. If I have that fixed fee, then I have to take my break-even point, my fixed costs for the booth fee of $1,000, divide that by my contribution margin per unit, which is $100 selling price up here, minus the variable cost to print the book, $50. And you can see I have to sell 20 books just to break even. So in order to break even, your instructor must sell 20 books. The profit per book is $50 once the break-even point has been reached. So now, let's take a look at option 2. Option 2 says that I have a $500 fixed booth fee and I have to pay 15% of sales. So what am I doing? I'm going to adjust my break-even point a little bit, and I'm going to take into account that variable cost of 15% of sales because that's a variable cost. I got to take that into account. So now I'm going to adjust my $500 of booth fee, divide that by my sales price, minus my variable cost, give me my contribution margin. But now my contribution margin, is it really $50 like it was over here? No, it's not. Why is it not? Because I now have another variable cost tied to the sale of the book itself that I now have to take into account. So $100 minus $50 minus $15. I now have my contribution margin is adjusted now to $35. So taking my fixed booth fee of $500, dividing that by my new contribution margin of $35, and I need to sell 15 units just to break even. So in order to break even, I must sell 15 books. At this point, the profit per book sold is $35 once the break-even point has been reached. So now let's look at option 3. Option 3, 25% of sales with no fixed booth fee. Oh, so with no fixed cost, there is no break-even point because I have no fixed cost to account for. So the profit per book is going to be $25 on each individual sale. How did I calculate that? Well, I calculated that as my cost of the book, $100, minus my variable cost to print the book of $50, minus my new variable cost of $25 per book as a sales commission in place of no fixed booth fee. So what do I see here? I see here that my option 1 provides the highest break-even point, while option 3 has the lowest break-even point because there is no break-even point. One thing I do want to notice, though, is that the higher the break-even point, or let me put it this way. Once the break-even point has been reached, the profit on each book will increase, obviously. I want you to look at this here. My break-even point, the higher the break-even point among these alternatives, once I've reached my break-even point, the profit per book sold increases, the higher the break-even point. I have to only get 20 books here sold, but once I sell those 20 books, that booth fee is covered. There's no variable component. So the remainder of that $50 contribution margin is all mine. Now let's look at option 2. I now have that fixed booth fee and also a variable percentage of fees here. So in that variable percentage of fees, my break-even point is lowered because I'm only having to pay out $500 in booth fees and 15% of sales. But once I've made my break-even point, the profit per book is sold as $35 once the break-even point has been reached. Well, whereas option 3 here, there's no break-even point. I only have a profit of $25. So if I am willing to take a risk to get the reward of a higher profit per book, then I'm going to exercise either options 1 or 2 here. However, for those who are risk adverse, option 3 might be the better way because there's no flat fee to pay and to risk losing anything. If I'm just giving them 25% of sales and I have no sales, there's no fixed booth fee, no sales, I owe them nothing, I'm clear to go. Option 1 and option 2, I have a fixed booth fee component, so those have to be paid regardless of whether I sell 15 or 20 books and reach my break-even point or I don't. So let's say I sell 0 books. Which option is looking pretty attractive now? Option 3, because I owe the fair nothing. Which option is going to look really worse? Option 1. So those who are risk adverse will choose option 3, while those who are not might choose option 1, and then to some degree maybe option 2 if they want to reduce their risk a little bit, but they're not totally risk adverse. So we'd have to take a look at the measure of risk also that we're taking, but also as you learned in finance class, there's that risk reward component. Once you reach that break-even point, the higher the sales are, the more profit you have. There's that risk, but you've also been rewarded for that risk. And that's tied, and how is that risk reward tied to? It's tied to the fixed cost of whatever action we're doing or whatever the fixed costs are. In this case, the fixed cost is referring to the booth fee. But once I cover my break-even point, the reward is greater under this option. There's more risk of losing more money if I don't sell any books. But what if I sell 50 books? Then I've sold 50 books and I have a profit of $50 each after my break-even point. So I have 30 books times $50 each, and I've made some good money. So So where my profit if I sell 50 books is less under option 2, and if I sell 50 books, my profit is even less under option 3. So there's a risk reward component to these different alternative cost structures that you're going to have to take into account with anybody in finance, with your company's financial risk-taking appetite or lack thereof. But this is just an analysis here, how CVP analysis can help us judge which option is best for us given our company's risk strategy. Another way to measure risk is taking a look at operating leverage. And that's examining the trade-off between risk and return, risk and reward. Operating leverage measures the impact that fixed costs have on changes in operating income. So let's take a look at the degree of operating leverage as measured by taking our contribution margin divided by our operating income. So simply our total contribution margin divided by total operating income. And we measure that, and the degree of operating leverage measures, so we know how to measure it, contribution margin divided by operating income, but what does it measure? Well, the measurement it actually provides is that the percentage change in operating income when there is a percentage change in sales. So in other words, the percentage change in operating income is going to equal the percentage change in sales multiplied by a degree of operating leverage. And to get a little bit more understanding of that and get a little deeper into that, view my video on operating leverage, and it will go into a little bit more detail with some calculations. So what do we learn here with CVP analysis and risk and operating leverage? The higher the degree of operating leverage, the higher their break-even point. The higher the return once the break-even point has been reached, and the higher the losses if the break-even point is not reached. And that's what the degree of operating leverage will tell us. The higher the degree of operating leverage, the higher the break-even point, the higher the return once the break-even point has been reached. But also, if we don't reach a break-even point, then that will be the higher losses. And we can use that degree of operating leverage, compare two companies, and use that as a way, if we're going to invest, to see which one has a greater risk reward. Maybe not to predict growth, but we can use that degree of operating leverage to measure company A and company B to see which investment, if we're going to invest in a company, will have the higher risk associated with that. So that's the degree of operating leverage. And that tells us a lot. I know I've briefly talked about just operating leverage. I haven't really spent a lot of time on it, just a few moments. So if you want to get a little more in-depth, view my video on operating leverage, and we'll actually spend just a little bit more time explaining it and going through that and seeing how that comes about. We can also do CVP analysis with sales mix. Do companies just sell one product? No. Companies typically sell a number of products. Now, the break-even analysis is simple enough when a company only produces one product. But how do we measure the overall break-even point for a company when multiple products are sold? So we're going to take a look at the total sales mix of all products and create what we call a sales mix. In other words, called bundles. Don't be confused by the term bundles. This is just a way of expressing the term sales mix and creating that proportion of sales of one product in relation to another sales of another product. So it's just a proportionate relationship here. So we're going to work an example here and show how sales mix and bundle and so forth. So let's see. For example, let's say we have two products, product X and product Y, and we are not dealing with the Acme Widget Company anymore. So for those of you who are wanting to get away from Acme Widget, here we go. So let's say we have two products, product X, product Y. During the year, we sell 4,000 units of product X and 3,000 units of product Y. What is our sales mix? Well, our sales mix, we're going to have to take their total unit sales of product X add to that our total unit sales of product Y to get our total sales units. In this case, 4,000 units of product X. We sell 3,000 units of product Y for total unit sales of $7,000. So now we're going to divide each one of these and take a look, and out of that 7,000, 4,000 is product X, 3,000 is product Y, our sales mix of 4-3. So we have a bundle of 7 units, and our sales mix is 4 units of product X to 3 units of product Y. So we can now use this ratio to determine the break-even point with some additional information. Now we need some additional information here, and we're getting ready to provide it. Assume fixed costs are $25,000 and that the contribution margin per unit for product X is $15 and $18 for product Y. What is our break-even point? So if you need to write this down, just pause the video, write this information down, because the next screen I'm going to explain the 4 steps, and that next screen is pretty compact. So if you need to write this down, take a moment, pause it, write it down here. We're going to take a look at our 4 steps that we need to do. The first step is we're going to need to compute the weighted average contribution margin of the sales bundle. Secondly, we need to determine the number of bundles needed to break even, or the number that we talked about before, the number of bundles. Thirdly, we need to determine the number of units of each product that we need to sell in order to break even. And then from there, we can determine the sales revenue by product line in order to generate break-even sales revenue for a total of product X and product Y. So we need to pause the video now. And then we are going to now take a look at how to compute the break-even point in units for product X and product Y. Okay, so look at the basic information here. Product X, we sold 4,000 units. Product Y, we sold 3,000 units. Sales price per unit, contribution margin per unit, sales mix. So we've got that. We got total fixed costs here. So now let's take a look at step 1, compute the weighted average contribution margin of the bundle. So what am I going to do? I'm going to look at product X and product Y, and I'm going to take their that proportion of sales in the bundle. For every 4 product X's, we sell 3 product Y's. So I'm going to multiply their respective sales mix by the contribution margin per unit for each product. So in the sales bundle of 7 units, what do I sell? I sell 4 units of product X at $15 with a contribution margin of $15 each. So in that sales mix, I'm going to get $60 of contribution margin from product X. Now for every 4 units of product X, I sell 3 units of product Y. And the contribution margin on those 3 units is $18 each, for a total of $54. So now when I add I add the 60 and the 54, I get $114 weighted average contribution margin. Now, I'm going to take that weighted average contribution margin, and now that is going to give me my break even in the number of bundles. So I'm going to take my fixed cost of $25,000, divide that by my weighted average contribution margin of 114 to give me 219 bundles. And it's actually a little bit less, but we're going to round it up. So we're going to round it up to the next highest bundle. And this is what we should do normally in break-even analysis anyway, because we never sell a partial unit, we sell units in whole. So we should say, if we have like 13.85 units as our break-even point, we should just round it up to 14, because there's no way to sell 0.85 units. So I've computed the weighted average contribution margin of the bundle, and I've now computed the number of bundles needed to break even. Take my fixed cost, divide by my weighted average contribution margin, and now I need to sell 219 bundles. Now I'm going to multiply the break-even bundles times the break-even bundles by the product sales mix. So on 219 bundles, and each one of those bundles represents 7 sales, 4 sales of product X to 3 sales of product Y. So out of those 219 bundles, I'm going to have 4 units of product X in there, which will result in what? 876 units being sold. And in that bundle of 7, each bundle of 7, I'm going to have representative of 3 units of product Y. So I'm going to take my break-even bundles needed times the number of units of Y being sold within that bundle, and that will give me 650 units. So now the total units I need to sell, 1,533 units. And that's assuming, though, that the sales mix holds at 4-3. 4 units of product X to 3 units of product Y. And again, this is just proportionality carried all the way through so that we can get down to the bottom line here. Now I know what? What do I know here? I need to sell 1,533 units to break even between the two. And if the sales mix remains 4-3, for every 7 units I sell 4 product X and 3 product Ys, I need to sell 876 units of product X and 657 units to product Y. Now I can compute the break-even sales and revenue by just taking the number of units I need to sell of that particular item to break even times the sales price. In other words, for product X, I need to sell 876 units. Multiply that by my sales price per unit, and the revenue I need to generate from product X is 30,660. Product Y, I need to sell 657 units at $31 a unit, and that will give me $20,367 in sales for product Y. So my total break-even in revenues is going to be $51,027. So again, there's proportionality all the way through, and if you look at that proportionality, you're going to see that flow all the way through it on a 4-3 ratio. So now, CVP analysis, we can also use that for service companies and for not-for-profit companies. It's relatively simple to calculate that for service companies and not-for-profit companies using the equation method of CVP analysis. So the equation method was what? Revenues minus total fixed cost minus total variable cost equals our operating income. So let's take a look here at an example. A local not-for-profit agency provides air conditioners to lower income and older people. Total donations for the year are $250,000. Each air conditioner will cost $250 to purchase. If fixed costs are $75,000, how many air conditioning units can the agency purchase for those in need? So we're going to do an analysis here. And we're going to sit here, and because we're not looking at the operating profit issue, we're just looking to see how many units can we get out the door. We're not worried about profit here. So my total donations minus my variable cost minus my fixed costs are going to be equal to 0. So I'm going to set one side of the equation, donations minus variable cost minus fixed costs, and we have to set that equal to 0. So here's my donations. The total donation is $250,000. My variable costs are $250 per unit of air conditioning minus my $75,000 of fixed costs. I am going to solve this algebraically. I am not going to do any super duper math thing. I'm just going to solve this algebraically. I'm going to isolate my X term to one side, and what I can do in this case is just easier to take my 250,000 minus my 75,000, leave that on the left side of the equation, and subtract my 250X that represents my variable costs from the left side of the equipment and put it on the right side. So now I got $250,000 minus $75,000 equals 250 times X. In this case, my equation comes out to be $175,000 equals 250 times X. Divide both sides by 250 to isolate the X term all by itself with a coefficient of 1. And I can provide 700 air conditioning units in order to provide cooler air for lower income and older people with that $250,000. One thing we should always do is especially when we're solving something algebraically like this, take that answer and plug it back into the equation to see if it makes sense, to see if we get that answer. So now I could take that $700, plug it back into my original line up here, of right here, and then see if that actually comes out to 0. If it does, I did it right. If it doesn't, I need to go back and check something here. But this is just a simple algebra problem, something we would have learned in 8th or 9th grade. So actually solving not-for-profit and service companies, something like this, is actually pretty easy compared to some of the other stuff that we do. So, and that is CVP analysis for not-for-profit and for service companies. So in other words, the agency will be able to purchase 700 air conditioning units to provide to those households that need them. So that concludes this session. I want to thank you for joining me, and I look forward to seeing you again soon.